Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, March 23rd, 2023. It is 1:53 p.m. Eastern Time. I'm starting the video, so we have about a couple hours left to go in the trading session. And anything big happens, I'll give you a market wrap. This video, we're going to cover something a little different. We're going to look at the financial sector, kind of a quick overview, a little bit of the banks, and I want to talk on the brokers, and I want to talk about something that probably I don't think is being discussed out there right now. Maybe it is. I don't watch much TV. I'm just not seeing it in the headlines I'm reading, and that is the brokerage accounts. Everybody listening to my voice has one, most likely, being this is a technical analysis trading site. And so I'll talk a little bit about the SIPC, Security Investors Protection Corp. My former life, I was a stockbroker, aka financial advisor, and very, very familiar with that. In fact, I just actually made an inquiry today to my broker regarding a question on the SIPC. I'll get to that in a second. But just a quick recap. There's the Nasdaq 100 back test, and again, the bearish rising wedge with a very, very clean up trend line. Negative divergence that have been building. Yesterday's post-Fed breakdown hit that 12,708 target bounce. And we still need to take out this trend line now for the next sell signal. So far, if you shorted the back test, congrats. It's a nice, good for a quick pullback trade so far off the highs. We've dropped about 1% so far. Nasdaq's still positive by a good amount. The futures, you can see in the bottom right hand corner, up about 1.5%. But again, this is just. I read the comments and I understand a lot get bullish and second guess, and that's fine. Trade what you're comfortable with. If you think the market's going higher, if you think this is QE2, I see the post. It's not just from the website here. I see what goes around. This is not QE2. The Fed shored up, pretty much stabilized for the most part, from what I can gather, has stabilized the regional banking system, and it's a net negative to the banking system as a whole. Additional costs, expensive, and particularly it's the big brokers. It's the JP Morgans and the Bank of Americas and Morgan Stanley. Those are the ones that game the stock. Goldman Sachs, they game the market. They have trading desks. The regional banks aren't, gaming the stock market, and so they're not really going to be a beneficiary of that. And again, I'm going to get to those real quick and talk on that. So again, I don't overthink it. There's a wedge. There's an impulsive breakdown. There's a back test, and that's that. And then that'll be the next sell signal when that level breaks. And then after that, you want to see yesterday's lows break, about 12,700, and so forth and so on. So it either happens or doesn't. Maybe we get that marginal new high scenario, maybe not. All I can tell you is what objective levels are to short. And likewise, if you're a bull, and I know I can see that quite a few that believe that the Fed is once again backstopping the market, or for whatever reasons you believe, then the same levels that I'm looking at as support to see a breakdown to trigger the next objective short signal, such as the trend line and then 12,700. Those are the levels that as a bull you want to buy pullbacks. If you believe the market's going higher, you buy the dip. Remember, short selling, if you're bearish in your analysis, whether it's technical analysis, meaning the charts like we're covering here, or fundamental analysis, which I talk about all the time as well, if your analysis gives you a strong case to be bullish, then at that point, then you view dips as a buying opportunity, not a reason to second guess your position, unless something changes in the charts or in the technicals or in the fundamentals. Likewise, if you are bearish and the charts indicate something's going down, you use rallies like today to short. It's the same exact thing in reverse as buying the dip when you're a bull. Okay, that's simple. All right, let's get to the charts here. We're going to start out with, let me talk real quick about SIPC, and then as I get to the banks, and we'll talk about that, because everything in the headlines FDIC, and they are not related. They're completely different types of insurance. And so what SIPC is, it stands for Securities Investors Protection Corp, and that is the insurance that most brokers, if you go to mainstream brokers, Schwab, Fidelity, Interactive Brokers, you're going to have SIPC coverage. And what it does, it up to an amount, it covers. There's there's money market funds. Read through it. I'm not going to sit here and go through all the nuances of it right now. But what it does basically, it doesn't insure your brokerage account against losses. If you got $500,000 and you put it in GameStop or AMC or Bitcoin or whatever it is, and you lose it, well, first of all, it has to be a security. Bitcoin not necessarily falling under that unless you're doing GBTC or something like that. But what it's doing is not insuring against losses in market value, but it will come in, and let's just say you had $500,000 in Apple or whatever your number is. I'm sorry, and make sure you're under the coverage limits, or cash in that account. You're a stock trader, you have cash, money sweeps into a cash account, money market, and you have positions. They'll replace up to a limit. They'll replace your cash, and up to the limit as well, they'll replace securities in kind. So if you had 100 shares of Apple, your broker, you turned around tomorrow and you went to log on and the website was down, you open the paper up and you read the Wall Street Journal or whatever the headlines are, and your broker failed and the doors are closed, and it's a slim chance, especially you'll see the cracks coming. But again, that's where they'll step in and replace those securities. So very important. Read through it, and what they don't cover generally are futures, and that's what I looked at today. I went into there and actually sent my broker a question to clarify that, because let me see if I can find it for you here. Where is it? Are commodity futures protected by SIPC? Commodity futures are protected by SIPC only if held in a portfolio margining account that is carried as a securities account pursuant to a portfolio margining program. Blah 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 blah. Interactive Brokers does have portfolio margin available. You have to apply for it and get approved. You need at least 100,000. So. And then it goes on, commodity futures contract held in an ordinary futures account are not protected. So I just want to bring that up for those of you trading futures. And here again, I'm not a fear monger. I might be at times bearish and telling my views on the market, both technically and fundamentally, but I'm not out here to sell fear mongering. And the time to kind of address this and know where your risks are now, in my opinion, not if and when the proverbial shite hits the fan, right? You don't want to scramble and then realize, okay, what do I need to do? I've got too much money at Merrill Lynch or Interactive Brokers or Charles Schwab. Just like, the time to buy life insurance or to get your will done is not when you're dead or dying, dead. It's, you want to do that in advance. And so you want to do this. So what I'm going to do is, again, you can check into that and see. But the segue here is I'm going to go over the charts and we're going to look at the brokers. And so here's one simple measure is if things happen to get worse in the financial system, in the stock market, particularly in the financial sector, and even then more particularly within the brokers, then that's where you might want to not have the amount over the coverage. By the way, most brokers have private insurance on top of SIPC. Go to your broker's website, you can look into all that and look at the details. But if things really got ugly, you might want to move some money into treasury bonds or some safe harbors and not have too much, especially in things like futures or individual stocks that are over the coverage limits. So IAI is a simple way to get a kind of the pulse on the brokerage sector. This is the iShares Dow Jones US Broker Dealers Index Fund ETF. So you can trade it, you can track it, and I'm going to go over just some, but not all the holdings right now, the components. So what I see, back here in the financial crisis, the last true bear market, you did have a divergent high leading up to the highs. It's to the left of this. This ETF came public right before that, but you can see a very clear uptrend line, which I believe we're going to. So many sectors, so many securities have these nice, clean, beautiful. I know I speak, charts to me are like artwork for the art, fan that I can look at a chart and say, wow, that's a beautiful chart, or one that's messy. I don't know. This is just a clean chart. There's a clean trend line, and in technical analysis, I've been doing this for many years. There's no guarantees, but more often than not, when you have a very well-defined primary uptrend line like this, you have these rallies, you get away from it, and you come back and check it. You get a mean reversion. You come and visit that trend line every so often. You can see there's almost a fairly regular frequency to that happening. And so it's a magnet to me. There's also very, very good price support that comes in there. If it's going to be longer, here's how this works. Here's how I look at the charts and how I look at this. I would say there's a very good likelihood, that means well over 50%, that before all said and done in this bear market, or in the coming, let's say within the next couple years, that this trend line is going to be hit. It could be in a couple months, could be, well, yeah, anywhere from a couple months to a couple years. Now, if and when it's hit, well, you can see I have one support level there about 71.30, and then another one right there about 61.50, and the trend line is dynamic. It comes in right now, it intersects. If we were to fall soon, it would come in there, and that would be the target, 60.51. However, as time goes on, if this is, continues to be a slow rolling bear market, as it has been so far and may continue to be, then it would be at this point we'd come in, that trend line would extend, and that would be, I can tell you, it would be, you can just take that line and extend it, and it wouldn't be till early 2025, maybe late 2024, before we hit that one. So if we get something sooner, this is what I think is more likely to happen. We hit it here, and that's this year. That shows us, just drawing that down like that, and that would be a pretty hard down. It kind of meshes with my scenario I laid out yesterday in front of the Fed. Just because we had a counter trend rally today, it hasn't changed anything technically for me, other than you had a additional shorting op if you missed the breakdown yesterday. So that'd be about a 32% drop, and if it happened, again, this is why I do this now. Everything's fine. I don't see any reason. I'm not moving money out of any brokers right now, and at least any that I have. There are certainly some in there that look ugly, I will say that. And this is what I'm doing too, is I'm encouraging you to look at your bank, like I did the other day with KRE, the regional banks, as well as XLF, and look at your broker, because I've done this in the past, been able to sniff out problem institutions when the sector's holding up or maybe going down a little bit, but all of a sudden one particular bank or brokerage firm is falling hard. There's something wrong. The market has sniffed out problems there, and that one's at a much higher risk of failing. So, all right, we're going to go through some, not all, just to see where we're at. And remember, we put in a divergent high right here, just like we had a divergent high right before COVID hit, and we certainly had a bear market in the broker dealers, and it hit that, brought us back to the primary uptrend line. So look at it this way, guys. If you want to be a glass half full person, even that 30-something% drop down to that 60-50 and intersecting uptrend line target, be about a 32% drop, would only be a correction, if you will, bigger picture in an ongoing bull market. If things get really ugly, we're going to take this trend line out, and then that's kind of maybe not Armageddon type stuff, but it's don't have too much money in your broker kind of thing. All right. Morgan Stanley, and I'm on a weekly time frame, by the way, so I'm going to rifle through these. Morgan Stanley, COVID took it below its primary trend line, but again, I've referred to this as Ursa Interruptus. It was a bear market that would have 100% had more meat left on the bone, but the Fed prevented it, and the federal government both, with excessive monetary and fiscal stimulus, and that's what kind of gave us this last leg up. It was like a dying patient, and the doctor came in and just injected them with a ton of epinephrine, adrenaline, and gave the patient a little quick little one last gasp, and that's probably what we have here. And then we'll go on and at least come down and check that trend line again, and ultimately go on and break it. All trends come to an end. Oh, and let's not forget, we're coming off one of the longest bear markets, secular bear markets and interest rates. You look at TYX, the 30-year Treasury bond, which peaked all interest rates, the 10-year, they all peaked back here in the early 80s, and we had a clear, unmistakable downtrend, which has ended. And it ended with the nuclear response from the Fed, and then and now by just about every metric, in my opinion, we've begun early stage new secular rise in interest rates, secular bull market. Yes, there will be corrections and pullbacks, but we're above trend, we're above previous reaction highs. Where am I going? No other sector that I can think of is as much as a beneficiary to a falling interest rates than the financials. So the era of the financials and all these insane profits you hear from the banks and the trading firms and hedge funds and the mergers and acquisitions, in my opinion, that's over. Doesn't mean we're going to crash. It's just that party is over, most likely, for the foreseeable future, let's just say. Okay, back to that. We were on a weekly, and I was going through the components. I started with Morgan Stanley, and so I'll just rifle through these and show you the common threads here. Divergent high most recently. Last time we had a divergent high was right here. You see what happened. Then before that was right here. You see what happened. We have right there. There was a financial crisis in 2008, and that's what happened. Okay, so we had a divergent high, and we are stair-stepping lower and headed to at least that level, in my opinion. Schwab. Okay, something's a little stinky with this one. There's your primary uptrend line. We're not far from it now. I would step down to a daily and tell you this is one that's had concerns recently. You had really good support. There was a support zone here, reaction high, you broke out, successfully backtest, put in a divergent low, rallied, but put in a divergent high. So this whole thing wasn't random. You know, the whole Silicon Valley Bank, which kind of triggered, repercussions throughout the financial system, not just in regional banks. We all know that, and took Credit Suisse down, for goodness sake. So there's Schwab, and Schwab's in a precarious technical posture. All these shenanigans the Fed's pulled lately still hasn't taken this stock back above there, and so I just keep an eye on it. It has this area of consolidation, not exactly a bear flag, but it's you have some similarities. You have an impulsive leg down followed by an area of consolidation, and just keep an eye on that. And their next support down there is about 51.64. And if you heard that buzzing, that was MBI. Just had a price alert. I must have had one set here to let me know if it goes under 828, but it's right on it right now. So sorry to get a little sidetracked there. I just don't know if you heard that alert go off as I was talking a second ago. IAI, I didn't even cover. I was on the weekly chart, but here's what it looks like on the daily, by the way, guys. There's your daily uptrend line. You had this, COVID kind of had an extreme, momentum yield overshoot, kind of panic sell off, but then trading normalized right here. So that's the trend line I'm using because it has the most number of clean reactions. And so on the broker dealer index, it's simply a breakdown and a back test. So I can tell you right now with conviction that is an objective short entry. I cannot guarantee you it's going to go down from here, but I can guarantee you 100%, in my opinion, that's a very objective short entry, a breakdown and a back test, and so far a rejection too. And your next sell signal would come on a break under right here, almost $85. You can see that recent low, and then take us down to 78.77 would be my next target. So that's something. Oh, and on the daily also, you put in even bigger, you had a little divergent high there. See, it was even bigger divergent high at resistance. A little stop clearing move. This is the nature of the market. You almost have to expect these false breakouts above resistance. It's as if whether it's the nefarious forces that run the stops, the big trading firms, trading desks, market makers, and all that good stuff. But it is what it is, and all I'm showing you is there's a beautiful bearish rising wedge. Broker-dealer sector is broken down, and it appears to be flagging, just like Schwab. And if that flag plays out, it could come fast. And again, that's why I'm doing this video. You want to get your ducks in a row, not when things get really ugly, because at that point, everyone will be in panic mode. And it may not get there, guys. Honest to goodness, I don't know. But I think if there's ever a chance, I can tell you right now, at this point in time, based on the technical posture of these charts, the probabilities of a problem in the brokerage sector is infinitely higher than it's been since 2008. Let's just put it that way. So now is the time to worry about this kind of thing if you are going to worry about this thing. So that was Schwab. I already covered that. GS, Goldman Sachs. Let me go back to the weekly. Paints a bigger picture. Just see what I have coming off a divergent high there. Kind of a sloppy chart. CME. This is one of the big brokers or exchanges. I'm sorry, the CME group. Look at that. Right on. That is beautiful, again, beautiful trend line, multiple reactions on this trend line, and we're dancing on it right now. So if it breaks that, coming off a divergent high, last time we had a divergent high was right before COVID. We hit this target here, and now we have another divergent high. And sure, you know, if you're a glass half full guy or gal, you buy the support right here. If you're glass half empty, because we're coming off a big divergent high, by the way, this divergence it's been culminating. It's a series of the previous divergent highs. It's just here, let me add that line. It's been extending. So typically the bigger the divergence you get, the bigger the drop you get, like we had back there in 2008 when CME fell roughly 80%. So, and we're flirting on there. We're right below the 200 days. It's, you know, it's we're not broken. We haven't broken down yet. We're at support. And look, there's a little bear flag I had highlighted back there, and that one played out almost to the target, but not yet. ICE, another exchange, intercontinental exchange. There it is. Look at that. Look at all these right on trendline support. That's why I'm doing this video. It's because we're right there. It could be one bad day, one more shoe to drop somewhere in the financial sector, or not, or we rally off here. But we are in a precarious technical posture. Price support just below it at 89. And I don't have a target until we get down here. I'd have to sharpen my pencils. A lot of these are old lines. I've had these charts marked up. That was created back in 2019. This line here was created recently. Yeah, I would have just put this one up. And Nasdaq, NDAQ, the Nasdaq or Nasdaq Inc. Not the Nasdaq Composite. This is Nasdaq. Beautiful little trend line, 2004, 2012, COVID, and there's our trend line. There's also some really nice support. This one split, so all my old annotations are moved, but the trend lines still fit. I went in recently and made sure all these trend lines are up to date. And that's the big level right there, about 47.15. If that breaks, it's going to be ugly. RJF, Raymond James. I haven't updated this one, but some of you might have accounts there, so I'll cover it here. Here's your uptrend line, comes off the 08-09 lows, last financial crisis. Nice clean reactions along the way. COVID hit, took it down. Fed would not allow a bear market or a recession. They refused, so they flooded the system with liquidity. It gave us this, but now that liquidity has been and will continue to be extracted. Okay, and since we are on that trend line on the weekly, I'm going to just go to the daily for those of you that might have. See, this one's already broken down on the daily. That's why I use multiple time frames. There was a clean uptrend line on the daily, clear negative divergence. So again, it wasn't this whole drop in these brokers was random. It happened there. It was technically induced, and it's been doing this for a long time. The fundamentals so often align. They go hand in hand with the technicals, and they align. So typically you have the bearish technical setup and then a bearish fundamental catalyst, which in this case was Silicon Valley, or a combination of everything that's gone on recently, including but not limited to the rates going up. Nice support right there, and I would set an alert there if it breaks 85.61. You have little minor support there around just under 82, but there's a big old thin zone. When I say thin zone, if you look at these volume at price histogram bars, that's where most of the trades have occurred, right here in that mass of trades, and there's really not much. That's the target. I'll just it's at the bottom of the thin zone right there, 67.55, and that's going to be pretty ugly. And if that happens, then it's going to take you below the weekly uptrend line. All right, so that's it. I'll go to this one because I threw it out as a trade idea recently. It was a long trade idea I highlighted back here. It was one of my favorites. I like that one, and it certainly rallied up. We did real well, took out the trend line. But now you have this divergent high here, strong negative divergence. And as I mentioned, this one was earlier this week or last week to take a starter short here, which I did, and then only add if and when that trend line breaks. And we'll probably come back to at least that 335-ish, 336 level right there. All right, a couple more. CBOE, again, another exchange. There it is, beautiful uptrend line long term on this weekly chart right there. Little minor uptrend line. If that cracks, it's going to bring us to the larger bear market uptrend line there. bull market uptrend line, I'm sorry. So this is that minor trend line I just showed you on the weekly right there. And of course, it's not just trend line. You have this divergent high. You had a divergent high right here, actually, right there. You had that drop. You had a divergent high right here and one right here. And so simple stuff, really. Boom, boom. All right. Interactive brokers, okay. This is one of the brokers I have. Highlighted this one recently. You have big level here at about 80.36, quad highs, major reaction high there, breakout right there, and a false breakdown. But again, it's sort of like the indexes right now. Will the real whipsaw step forward, please? We don't know if that's going to be what's going to be the whipsaw, but because we shot down after failing the breakout. We clearly went down, but then we bounced on the 200-day moving average, which we've been bouncing on. Back here it was resistance. We snapped back above 80.36, but then now we're a hair below it. So, based on the divergences, as I say, breakouts that occur to all-time highs, or any breakouts that occur with negative divergence typically fail. So I think this is just the first leg down with a counter trend snapback rally to back test, little momentum fueled overshoot. Remember, the Fed, you're going to get these whipsaws. That's just part of Fed week. Remember, the Fed is not a one single event at 2 p.m. on Wednesday. It's a series of events. Like I said, the initial announcement, then Powell's speech, and then it takes the market a couple days to digest everything. So that's that. And like I said, so if you have a good chunk of change in any of these brokers, watch it. It's a bearish technical posture. Where do I start getting concerned? It's not any one level, it's collectively. What's going on in the big banks? What's going on in the brokerage sector as a whole? What's going on with my particular brokers? And at that point, if I deem it necessary, I'll move some money into things that are certainly covered, out of futures into things like treasuries and individual securities. Like I said, you can, instead of shorting the Nasdaq 100 futures, if I'm still bearish looking for a crash scenario, I can just go in and short my fill of Apple and QQQ and the things like that are covered under SIPC, or also spread money balance it out among various brokers to make sure I'm covered under those limits. So again, guys, I'm not trying to spread fear or anything. I just wanted to tell you these are the things I watch, and the cracks continue to form. We're going to wrap the video up here. So there were a couple posts I saw in the comment section about, oh no, we're going up because the Fed, what they did is massive. The whole, I forget the acronym of the bank bailout plan, but yet, okay, so why does it look like the regional banks are flagging here? This is KRE. Why aren't they rocketing up if this is such a, if we're looking at a new round of QE? This market's saying there's something wrong. You went down, and this is typical almost of a bearish pennant, or more of a pennant. Same thing as a bear flag. A flag just looks like this. Well, like that, and the pennant looks like that. And so now we're breaking down. And if it plays out, it could play out fast. If it is a bearish pennant, the measured move would be the length of the flagpole, just like on a bear flag pattern. That would take you down there. And then you look, I go within the sector, the regional banking sector. I'm going to sort by the biggest losers today. So here's a bank that I'd be a little worried if I had a lot of money in. FFWM, First Foundation. I know that they've said they're going to backstop everything with FDIC insurance, but your money could get tied up for a while. Pac West continues. These are just ugly charts. And FRC, First Republic, still selling. Zions Bank Corp. You get the picture. You can do this yourself. Sort these and just see that things still don't look well in the banking sector. And then finally, the big financials. Let's see what's looking bad. Comerica, FRC I already covered. I just have these sorted in order here. Let me do this. Let me go by market cap real quick. And I'm going to run through quickly the top components of XLF, so we get a more broader picture of the entire financial system. That includes big banks, small banks, insurance companies, exchanges, everything. There's Visa. Visa looking okay, but it just recently came off a divergent high right here. Negative divergence broke down and probably headed lower. We can go to a weekly chart here and just kind of look at the bigger picture. There's Visa on a weekly. There's a trend line I have, the primary trend line, the best draw I could fit on here. And it shows that Visa broke down and it's back tested and got rejected. JP Morgan, you can scroll back here, you can see the blue line which will overlap. There's the 2009 lows. That was the bull market uptrend line. It broke in COVID, and the Fed wouldn't allow a bear market, so it snapped back, recovered, but we're back below it. So that's the second breakdown. We're below the bull market trend line, and of course after a divergent high. MasterCard below its bull market uptrend line. Berkshire below its bull market uptrend line. Remember, a lot of these had that, Ursa interruptus, little whipsaw, whatever you want to call it, breakdown, and it was in its own right a bear market. Most of these dropped over 30%. So breakdown, back test. If we start moving away from there, that's going to be an ugly thing for Berkshire. Bank America, again, is the banking system really saved? Well, this thing's still selling off. Had a divergent low there, didn't play out. Oh yeah, and look at XLF2 on a 60-minute chart. Look at this. This was yesterday. So there's the Fed day. This is just a 60-minute chart. There was a beautiful bullish falling wedge and broke out, but so far failing. And if it backtests, there's no backtest in sight because the trend line was so steep, it'd have to come way down here to backtest. So yeah, it's something worth noting. That breakout just got sold into, as I'm showing you here. So that's it. I could go through each and every one and it'll just bore you. You're seeing more of the same. American Express, these are big ones. These are the big companies that again, they were beneficiaries of decades of falling, and especially in recent years since 2008, uber low rates. But there's COVID was a breakdown for American Express, right? And nothing but a backtest. We backtested the primary bull market uptrend line a few times, and we've been moving lower since. So these are the things that formulate my longer term outlook, and why, unless this market really convinces me otherwise, I think this has just been we're at the tail end of a bear market rally, or the early stage really of the next leg down. And then when a lot of these break, these are powerful cyclical bull market uptrend lines. SPGI is S&P Global. I mean, you can see it cracked here recently, and it's been back testing, and it's starting to roll over after back testing that primary uptrend line. The last time it had, look, here's the last bull market in this one, was from 1996 right there, or 95. All the way up to the 2007. That's when the last bear market started, and that's what it looked like, right? And then that's bull market, right? Bear market, bull market, bear market coming up, and it's going to be a bad one, I think. So, and it's like I said, plenty more meat left to go, especially if these break down. So maybe I'm wrong. If I'm wrong, those that haven't broken support will rally off those trend lines, and those that have broken or below, they'll regain them and go up. Okay, and if I'm right, you want to watch if these guys start moving farther away, and those that haven't yet broken trend start to break trend. And there's Schwab right there, Goldman Sachs, it's a messy one, BlackRock, look at that coming up on the trend line, PayPal, ugly chart, look at that, can't get going, big divergence, just couldn't rally. It's bear market stuff. Citigroup, not looking so healthy. Again, Citigroup's been dead money for a while. PGR, Progressive, ready to crack that. There's your primary trend line. Chubb, big divergent high on the weekly. They're all there. I'm going to wrap it up here, guys, because all I'm going to show you is chart after chart that either has divergent highs and or long-term primary trend lines that are either recently broken or could be broken soon if they go down much more. And so yeah, just don't underestimate how fast, once all that starts to happen and market realizes that with this Fed pivot, because that's it. I mean, this market right now is banking everything on this Fed pivot, and I'm not buying it. And even if they do pivot, I think the damage is done already with what they've already done with the rate hikes. So that's my opinion, guys. All right, I'll wrap it up here, get the video out to you, and continue to hunt for new trade ideas. This has been Randy Finney with Right Side of the Chart. Have a great day.